Good afternoon, everyone. Welcome to the seventh webinar in the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. Today, we will focus on the critical topic of government grants, accounting, and disclosures. We hope this session provides you with valuable insights, clarity, and practical perspective on the real world challenges in this area. A warm welcome to our esteemed speaker, CA Nilanjan Paulji. Before we begin the technical session, I would like to introduce our moderator for today, CA Kashish Arora. CA Kashish Arora is a dynamic chartered accountant with practical experience of 4 years in financial reporting, auditing, and assurance. He began his career in 2021 in audit and assurance domain with one of the big fours. Currently, he is a part of a financial reporting and controllership function at one of the India's leading aviation companies. Now, I would request CA Kashish Arora to take the session forward by introducing our esteemed speaker for today, CA Nilanjan Paul. Over to you, sir.
Thank you so much, sir. I truly appreciate the kind words and the warm introduction. Good afternoon, everyone, and welcome. I would like to thank our esteemed Chairman, Accounting Standard Board, CA Sanjeev Singhal, sir, Vice Chairman, CA Vishal Doshi, sir, CA Alok Garg, sir, and CA Shalini Jindal, ma'am, for giving me this opportunity. It's an honor to be part of this session. I am Kashish Arora, and I will be your moderator for today's session on a topic that's quite become a very big deal in the world of finance and corporate reporting: accounting for government grants and disclosure for government assistance. Over the past few months, if you have read the business section of any major newspaper, whether be it's Economic Time, Mint, or Business Standard, you would have seen headlines around the companies receiving government incentives, particularly under the PLI schemes. For example, just last month, there was an article around Apple suppliers like Tata Electronics and Dixon Tech receiving substantial payouts under the PLI scheme for mobile manufacturing. Another headline highlighted how auto companies and EV battery makers are preparing for disclosure for upcoming financial year with subsidies running into hundreds of crore, as we all know that EV and renewable energy is quite a booming sector these days. And while these schemes are great enablers for growth and investment for the business, there's also a flip side. They bring along the accounting and disclosure responsibility, especially when the companies are public, audited, or preparing to raise the capital. The reality is, when the grant is material, the investor wants to know, is the benefit already accounted for in the earnings? Are there any performance conditions attached to it? Is the disclosure clear enough to understand the nature and timing of the benefit? So these are some practical challenges we see not just in large listed company but also in private enterprises. Even the startups these days are receiving the government aid and companies preparing for IPOs as well. So today's session is incredibly timely. While the technical guidance comes from Accounting Standard 12 and Ind AS 20, our focus here is to how to interpret and apply the standard in the real world and what are the nuances around this topic. How do you communicate grant income to the stakeholders, and where does it sit into our P&L or balance sheet? And how do you deal with the grant conditions which have not been fulfilled? So, to help us navigate this question, we are fortunate enough to join by Mr. Nilanjan Paul, sir, who is a partner with MSKC and Associates LLP. He is a subject matter expert with deep experience into corporate laws, financial reporting under Indian and international GAAP, and complex auditing matters. He also provides technical leadership and guidance to audit teams on how complex and judgmental matters, thereby upholding the firm's quality standards and professional reputation. One of the core responsibility of SIR is to provide consultation on intricate accounting treatments, interpretation of financial reporting frameworks such as Ind AS or IFRS, and auditing procedures involving areas of significant risk or estimate. Sir also closely works with various initiatives of ICI, including contribution to committees like auditing and assurance boards and accounting standard boards, to name a few. I'm sure he will bring clarity to, especially through real life examples and practical illustrations. So, just before we begin, a couple of quick points. Feel free to ask your question as we will cover them in Q&A section at the end of the session. Once again, thank you for joining. I'm looking forward to this insightful session. With that, Nilanjan sir, over to you.
Thank you, Kashish, and a warm welcome to everyone who are joining us today. And I thank the Accounting Standard Board for giving me this privilege of connecting with all of you. I think, as Kashish rightly mentioned, the government grants which the government of India has laid down for some sectors, specifically for the mobile phones and electronic sector. They are actually making strides across the Indian economy. Recently, we also heard about the employment linked incentives, which the government just had introduced, and we expect it to also, enable those corporates for much more wider uh, penetration in the job market as well. So with this, let me share the slide deck. Yeah. Okay. So accounting for government grants, as far as the Ind AS portion is concerned, that is driven by Ind AS 20, and it is very well or very closely aligned with the the AS 20 on accounting standards, which is followed by non-Ind AS entity. We'll also try to cover some of the key differences so that we are able to evaluate and appreciate those points better. But the idea of this session is to have a two-way communication. Please feel to ask your questions, as Kashish mentioned, and I'll try to navigate you through with certain examples and real-life case studies. So the agenda is on the screen. We'll try to navigate through the entire standard, starting with the key definitions, recognition and measurement, presentation, refunds, if there is a need to refund the government grant, how the Indian auditing standards are different from the accounting standards, and what are the common pitfalls that somebody would like to avoid, right? So let's start with the scope and definition. As far as the scope is concerned, under Ind AS 20, the standard deals with accounting and disclosure of government grants, right? It also deals with disclosure of government assistance. So what is the difference between a government grant and a government assistance? We would also have some slides to take you through. As far as the out of scope scenarios are concerned, the standard do not apply to participation of the government on the ownership of the entity, because in that case they're acting in capacity of a shareholder and not as a grantor. There are other sectoral specific exceptions. For example, in AS 41 on agriculture, there are specific considerations and they have also been scoped out. Now, if there are special problems on accounting of on understanding the effect of changes in prices, this standard also very clearly scopes them out. Now, another or a very common form of an incentive is where the particular scheme provides a reduction from determination of taxable income under the Income Tax Act. So that, for the purpose of this standard, is also scoped out. So on this slide, what we're trying to tell you is that generally, if there's a scheme to incentivize a particular entity or a particular class of entity subject to they making specific compliance, then largely it will be under the standard of Ind AS 20. Obviously, there are certain exceptions, as we can see on the slides, but largely they will fall part of Ind AS 20. Now, key definitions. You will hear these three words throughout the discussion that we are having. So the first definition which I want to highlight is the definition of government, right? So generally, the government is understood to be the party or the group of individuals who would be elected in our country, and they would be running the government at a central level. But as far the standard is concerned, they don't differentiate between a central or a state government. They use the term government in general. So any scheme by a central or a state government or any local body, let's say you have a jurisdictional body at a particular state, at a municipality level, that also will fall under the definition of government as far as the accounting is concerned. Now, similar considerations apply even for international bodies, So if you have components who are outside India, or if you have a branch outside India, in that case as well, the definition of government under Ind AS 20 would uniformly apply to those uh, components or branches. The second definition is about government assistance. So if you would look at the slide closely, what government assistance actually mean is an action by the government, right, which is intended to provide economic benefit to an entity or a specific range of entity subject to they meeting specific criteria. So I want you to note the word action, right? We are not talking about economic benefits or transfer of resources, but it's an action which the government would like to uh, exercise. Now, on this context, if you would read the definition of government grant, it is it is a bit overlapping, but it tells you a very important distinction. What is meant by a government grant is an assistance by the government. So they are dwelling on the definition of government assistance. So as far as the standard Ind AS 20 is concerned, the first thing is that the government grant should be a form of government assistance, right? So if it is a government assistance and they transfer resources to the entity in return for some performance condition, past or future, and those are linked with the operating activities of the entity, then they are government grants. So if I have to simplify this definition further, we're talking about a subset of government assistance with three important aspects: transfer of resources, compliance with past or future conditions, and it should be linked with the operating activities of the entity. So with this, let's move to the next slide so that we can deliberate on this topic further. One of the very common confusion or possible observations by various stakeholders is whether I'm identifying the grant properly, right? So probably we'll spend a few more time here to identify to assess whether we are appreciating the definition of government grant, right? So as I said, it must have three conditions: transfer of resources, compliance with condition, and relates to operating activities, right? So if I have to build on the first box further, government assistance, that could be in the form of a cash transfer where the government gives cash to a particular entity, or there is a reduction of liability. For example, they give a waiver for a particular liability, right? A particular due, that is also considered to be a transfer of resources. Or there could be instances where there are incremental resources, for example, refunds or forgiveness of existing obligations. So in a nutshell, in the first box, what we're trying to identify is either there is a transfer of cash by the government to the entity, or there is a waiver or forgiving of an existing liability due to the government, right? And all this will happen under a particular scheme which the government would try to establish. Moving to the second box is compliance with conditions, right? So in this uh, box, what we're trying to highlight is that when you're talking about compliance with condition, it could be a past performance condition or a future performance condition. So let's say you are operating in a particular backward area, you are there in a particular time frame. If the scheme acknowledges that kind of a setup and you are eligible for a particular amount of grant, that compliance with past conditions will also make you eligible for government grants. Similarly, if there are forward-looking conditions, for example, you employ new employees in your factory and they are staying with the entity for a prescribed period of time, which makes you eligible for a government grant. So again, a compliance of condition, past or future, that should also be relevant. What we would also like to highlight that these compliance with condition are sometimes implicit. They are not explicitly stated in the terms of grant. But uh, but if there is an implied kind of a condition, and if those are also required to be fulfilled, then you tick the condition number 2, where you are supposed to comply with these conditions. One aspect, well, again, which I would like to highlight is if those conditions that we're talking about in the first bullet are substantive, right? It is more likely that the relief is kind of a government grant. Okay. The third box where we're talking about is that the grant should relate to the operating activities of the entity. So again, a factory would be a very common example which we all can relate to. If you are engaging employees in a new factory from a particular income level, or let's say there is a grant which is helping to strengthen the ecosystem of micro and small enterprises, and this relates to the activities of the entity, then again, that is a qualifying condition for government grant. Uh, One more word of caution that when we are looking for assessment of government grant, it is important to understand the nature of these reliefs and conditions. As I said, sometimes the conditions may not be explicitly stated. So a very careful reading of the substantive conditions of the government scheme is relevant for spotting a government grant. Now, uh, in certain cases, what we have seen is that there may not be a specific condition, right? But it might happen that you operate in a particular sector or a particular industry, right? So that itself becomes a condition, right? So you may not have a very detailed financial number linked grant, but if you are eligible for a grant because you are operating in a particular sector or a particular industry, more likely than not, it would qualify as a government grant. Yeah. Okay. So let's understand this better by way of some examples. I think we are aware of the employee linked scheme, which the government had recently announced. So this particular case study is modeled on that. It is not exactly a copy of that scheme, but you can relate to that to understand the principle of this standard. Let's say there is an entity who is eligible under the employee linked incentive scheme. Now that scheme requires or the government to pay cash incentive for every first time employee employed by the company ABC. Now, and there is a scale-based incentive. For example, if your salary is, let's say, 10,000, you are eligible for X amount of government grant. If it is more than 10,000, but let's say 15,000, then you're eligible for a X plus certain amount of government grant. So it's a scale-based government grant. But one of the condition is that it has to be sustained for at least 6 months. So if the employees leave within a period of 6 months, then the entity is not eligible for government grant. So now let's see how this fits into the 3 boxes that we spoke. The first box, transfer of resources to the entity. I think this is quite simple. The government would provide cash incentive to the entity. So there is a transfer of resources by the government to the entity. Moving to the next box is of compliance with condition. So as you could see on this slide, there are 2 substantive conditions. First is that they should be new employees, right? So the idea of the scheme is to generate employment. So a person who is already have been employed, and generally it is traced from the EPFO database. If that person is not appearing in that, and if he is getting employed for the first time, then that employee becomes eligible to be covered under the government grant scheme. Second is that the employee should be continued for employment for 6 months. So there are 2 conditions which the entity would need to fulfill, which is that it has to be a first-time employee, and the employment should continue for next 6 months. Let's move to the third box, which which is about the operating activities. So if the company is engaging employees, then it is expected that they will be used for the purpose of its operation. So again, the third criteria is met. So transfer of resources, compliance with condition, and entities operating activity, as I said, are the key criterias that should be used to identify whether a grant exists. Let's take another example. Uh, let's say the company DEF has obtained a below market loan from the government, right? So for example, if the entity has to obtain a loan from a bank, probably they would need to pay 10% interest. Now, there's a scheme of the government which makes this entity eligible for a lower than market interest rate loan, right? And that loan will again be utilized by the entity for for making investments in eligible plant and machinery. So again, if you would visualize those three boxes, there is a transfer of resource because you are being charged less amount of interest as compared to the market rate. So to that extent, there is a transfer of resource. There is a compliance of condition that they will be used for purchasing eligible plant and machinery. And third, it relates to the operating activity of the uh, entity. So the moot point for this particular example is that even though there is no transfer of cash, but a facility of availing a lower than market interest rate, right? That is also a government grant as far as the standard is concerned. Okay. Let's take another example, right? An export-oriented unit which can claim incentive to the extent of 2% on FOB value, and those incentives are given in the form of scripts. So earlier in the day, we used to have various schemes. For example, the Target Plus scheme or the DEPP schemes. Similar to that, there is a scheme which the government has framed for export-oriented unit, and they're eligible for scripts. So you do a particular activity, you earn those credits, and those credits can be used to offset future expenses or future cash flows, or they can also be sold in an open market. So in this case, the question is that whether this transaction is is governed by Ind AS 20, or it should be treated as a revenue under Ind AS 115. So one of the key distinction which I want to highlight is that Ind AS 115 deal with contract with customers, right? When you are a customer, you are selling goods or rendering services, and for which you are getting a consideration. These type of particular schemes, there is no uh, sale activity which the entity is carrying out, right? It is like a incentive mechanism which government has formed. So simply put, uh, in this particular scenario, the scripts or the benefits that we get from the scripts are accounted for under Ind AS 20, and they are not in the definition of revenue under Ind AS 115. Okay. Now, I also spoke of government assistance, and I somehow gave a very brief kind of a distinction between government assistant and government grant. Okay, so as I said, government assistance is a much more wider term. Government grant is a subset of that. And as far as the standard is concerned, they very clearly articulate that the government assistance can be in various forms. It could be varying in nature or assistance, and also the conditions, right? So the standard also very clearly states that government grants under the standard, they exclude government assistance for which you can't place a value, right? And they can't be distinguished from a normal trading activity. So if this is the case, then it might be a government assistance, which would trigger a disclosure requirement in the financial statements. But as far as the government grant is concerned, and that particular transaction is not then a part of government grant. So let's understand this through an example or through some considerations, right? So for example, there are two items which I felt is relevant, which could explain that it is a government assistance, but not a government grant. So for example, there is a mechanism which the government has laid out for certain smaller and medium enterprises, wherein they are given a priority in bidding for a particular government contract. So again, you can't place a value. You are given a quota, right? And you are eligible to avail that quota. You can't place a value, right? And obviously, you can't be able to segregate the contract with the activity of the entity. So this is a very simple example which I felt would be able to help you appreciate how government assistance and government grants are different. Okay, so let's move on to the next set of topics, which is recognition and measurement. Now, as far as the recognition is concerned, which is basically at what point in time the government grant should be recognized, the standard Ind AS 20 very clearly articulates that they should not be recognized unless there is a reasonable assurance that the entity would be able to comply with the condition attached to them and that the grant will be received. So I would like you to note the word reasonable assurance, right? So generally, reasonable assurance is a very common terminology in the auditing context, but from a financial reporting context, that is not defined at all. So we'll also have certain considerations to understand what is meant by reasonable assurance. But the moot point is that there has to be a reasonable assurance, and there are two conditions that should be fulfilled. One of them is that the entity will comply with those conditions, right? That is condition number one. And the other condition is that the grant will be received, right? The standard also articulate that the manner of receipt of grant does not change the method of counting. So for example, if a grant is received by cash, or there is a forgiveness or a waiver of a liability, that doesn't change the nature of grant or the manner in which accounting to be performed. Ind AS 20, or rather all Ind AS, as we all know, are principle-based standard, and they are more driven by substance of the transaction rather than the form. Yeah. So one of the common question that we all get is that, is reasonable assurance same as probable, right? So probable, as we all know, is a concept that is used under Ind AS 37, which talks about provisions and contingent liabilities. So generally, a probable is understood to be more likely than not. If it is expected that a particular event is likely to happen, and in that case, Ind AS 37 very clearly says that you meet the criteria of a probable kind of a liability. But is reasonable assurance same as probable? If you would look at the standard, its intent, I think they go a step beyond. Reasonable assurance is generally placed at a higher threshold as compared to probable or more likely than not. And it's a very, 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 very high threshold. So on a scale of 1 to 100, if probability is, let's say, 51 or 52%, a reasonable assurance will go much higher. Now, again, there is no numerical threshold, or there is no bright line which will tell you when you have met the reasonable assurance criteria or a probable criteria for that matter. The preparer of the financial statement has to apply judgment. But what I would like to caution you is that the wordings of the standard, or if you will look at the substance of the transaction, they are looking at a very, very high level of assurance, right? So a very high level of assurance, as far as the standard is concerned, is not equated with what is meant by probable under Ind AS 37. Uh, Again, an entity cannot recognize government grant before it is significantly clear that it would be able to comply with the conditions and the grant will be received. Another question could be that should the reasonable assurance criteria be checked only at the time of initial recognition? I think it should be checked not only at initial recognition, but it should be checked on a continuous basis, right? uh, Till the time all the conditions are fulfilled, or till the time the grant, if any, is claimed backed by the government. So in a nutshell, the reasonable assurance criteria should be verified not only at the initial recognition time, but also throughout the continuance of the recognition of grant transaction. Okay, let's understand this more by way of an example. Let's say there is a government scheme which is helping to drive investment in artificial intelligence, right? Uh, Under the scheme, the government will provide financial support for next 2 years, but only for very, very specific costs. For example, let's say you buy a cloud server, or you uh, uh, engage a technocrat who will write down the code for developing an AI tool. Those are the costs which the government scheme aims to incentivize. Now, as far as the process is concerned, the process is quite complex. The entity would be required to submit a detailed cost, uh, a budget, along with budget versus actual, right? Whether they have been specific amount of funding in the past, or what are the future cost. So the process is in itself is quite complex. Now, if the application is accepted, or for the consideration of the government, there is a very extensive approval process wherein there is an independent reviewer, right, which will go through those documents. I think many of us could relate to the performance linked incentive scheme issued by the government, where the application process, as well as the review process post submission of the application, is quite rigorous. So let's visualize those kind of a scenario, which is a very new scheme to a particular uh, entity or a particular sector. So, uh, since this is also a new scheme, the entity obviously doesn't have any past experience for it to reliably estimate whether they will be able to meet the government grant or criteria or not. So the main question is whether reasonable assurance criteria is met. So here I would like to highlight that the standard envisages the entity to apply due care and judgment to be normally assured that they would be able to comply with those conditions. So if there is a proper trail of document, if there is a proper assessment of what those conditions are, and I have been able to prepare my documents and submit those documents based on my understanding of the laws and regulation, then in that case, the standard believes that the reasonable criteria is met. But that does not take away the fact that there could still be a measurement issue, right? So at this point, we're talking about the point in time in recognition. The standard in this scenario also cautions us that how much government grant should be recognized, that would need a careful consideration. But I felt this is a good example for us to explain that in a emerging kind of a sector, whether what will be that point in time when the reasonable assurance criteria is met. Okay, so now let's take a reverse scenario where I have received cash from the government, but I'm still required to comply with certain conditions. So the moot question is that if you have received money from the government under a particular scheme, subject to you complying with future performance condition, does it mean that you're eligible for government grant income in the financial statements? I think the answer is straight cut no, because only because you have received money, that does not mean that is not a conclusive evidence that all the conditions attached to the grant have been fulfilled. There are forward-looking or futuristic conditions that the entity has to fulfill. So again, a point to be highlighted that merely due to receipt of cash doesn't lead to recognition of grant income in the financial statements. So in this scenario, what I would advise is that the money received from the government should be shown as a liability in the balance sheet. Since the conditions have not yet been fulfilled, so you would not be permitted to recognize the grant income in the statement of profit and loss. Let's move to the next part, which is the measurement. Now, under the standard, and if you could also recall the requirements given under Accounting Standard 20 on government grant, they also talk about two type of approach, right? And this has been debated at length, both locally as well as internationally. But as far as Ind AS is concerned and AS20 is concerned, they continue to foresee two possible approaches for measurement of government grant. One is the capital approach. So the proponents of this view argue that government grant is more of a financing device. If the government is going to incentivize a particular activity, they're acting in capacity of a financer, right? So in that case, it would be appropriate that the grant income or the money received from grant should not be recognized in the profit and loss, but should be recognized outside the income statement, which means typically in the equity. It is in the balance sheet, which somebody can argue to show it as a capital reserve, or somebody can even argue to net this off against the underlying assets or liabilities. So that is one view. Uh, those those proponents also argue that uh, how can you recognize a grant income without a related cost, right? So for example, if the government is giving you a benefit, there is no corresponding incremental cost, and hence they are not akin to a revenue generating activity, and hence capital approach should be followed. On the contrary, the income approach uh, basically envisages that these are receipts not from the shareholders. So on the balance sheet, on the liability side, if you include a reserve or a share capital, they are supposed to be repaid back to the shareholders when they ask for a return of investment or when they ask for return on investment. So these are not received from shareholders, but they are received from government, and accordingly, a capital type approach may not be appropriate. They further argue that the government grants are rarely gratuitous, which means that they are not free. You have to comply with certain conditions, past or future, implicit or explicit, which will lead to incurrence of certain cost, and the government grant seeks to compensate you for those costs. They also draw analogy from income taxes and other taxes, which are recognized more of an expense. So there are merits in both views, but as far as Ind AS 20 is concerned, or the international standard corresponding is also concerned, they have rejected the capital approach, right? They believe that income approach would be the appropriate uh, manner of recognition of measurement of government grant. Now, I also mentioned about AS20. We'll have a separate slide to talk about the difference between AS20 and Ind AS, AS12 and Ind AS20. But since we're talking about the differences, AS12 still acknowledges the capital approach, right? So as far as Ind AS 20 is concerned, they have rejected capital approach, which is continued under AS 12, and under Ind AS 20, government grant should be measured only using the income approach. Yeah. Now, if we have to follow the income approach, what should be the measurement mechanism? Now, the standard articulates that the income from government grant should be recognized in the profit and loss on a systematic basis over the period in which the entity incurs related costs for which grants are intended to compensate. So, for example, if you have a plant and machinery, it is expected to be depreciated over a period of 5 years. The government grant would be recognized over a period of 5 years to compensate the cost of depreciation. Similarly, if there are other administrative costs, for example, payroll or some other rental costs for that matter, and the grant is expected to compensate these revenue costs. So again, they have to be recognized in the same fashion of incurrence of these administrative costs. Now, when you are trying to measure the government grant, it is very critical that that you establish a relationship between the grant and the related expenditure, because the standard only refers to the fact that there has to be a systematic basis over which the grant should be recognized. They don't lay out a specific basis, or they don't even negate what basis is not appropriate. A systematic basis, which the management again would need to apply its judgment and recognize the grant on the principle that they are supposed to compensate for the cost that have been incurred. Okay, so let's understand this concept again with some examples, right? So there's a debate of asset versus income. So whether a particular grant relates to an asset or relates to an income. Uh, let's take an example of an entity which is in the which is eligible to seek exemption of custom duty on capital goods, right? Under the export promotion capital goods scheme of the government. Now, whether the same is an asset related grant or an income related grant, right? And why is this different, or why is this important? Because they help you to identify what is the basis on which the government grant is recognized. But before we go to the response, I would like to highlight is that when you read through these grants, in my experience, they might involve a degree of legal interpretation to understand what is the intent of this particular scheme and what is that the scheme is envisaging to compensate. So the first criteria, whether this is a government grant. So yes, this is a government grant because you are exempted under a particular scheme from custom duty. So it is a government grant. Now, as far as the classification of the grant is concerned, whether it is a asset related or an income related grant, as I said, it would require a significant judgment and careful assessment of objectives of the scheme, right? Uh, the significant judgment is expected to be exercised regarding ascertaining the purpose of the grant. What is it that the grant is expected to compensate or intended to compensate? Is it that they're trying to fund a particular capital asset, or they are trying to reimburse you for a expenditure? So in this particular case of EPCG, if the management believes, based on their judgment, that the grant is to compensate for import cost of assets, and the fulfillment of export obligation is a main condition. In that case, the grant should be recognized in the profit and loss on fulfillment on export obligations. So, as and when you export goods, you become eligible for the custom duty benefit, and that is the systematic basis over which you should be recognizing government grant. Otherwise, if the management believes that the grant is intended to compensate the cost of the asset and fulfillment of export obligation is only a subsidiary condition, it is not the main condition, then it has to be recognized in the profit and loss over the life of the underlying asset. So as and when you recognize depreciation charge, that should be the basis over which you recognize the government grant. So, the idea of this example is to highlight, number one, that you might need to have a much more deeper understanding of the intent of the grant, and hence management judgment and support for that judgment is quite critical. This might even also require the management to involve certain expert, maybe a lawyer or a subject matter expert, to guide them on the objective of the government grant. And again, uh, based on that, the accounting treatment will differ. If there are certain conditions which are substantive conditions or main conditions, or or if it is a mix of both a primary condition and a secondary condition. Okay. Let's understand this recognition of grant again through another example. Uh, let's say there is a government grant where an entity is eligible for a grant of 60,000 rupees over a period of 3 years, and this is a scale-based grant. 40,000 in year one, and 10,000 in year two, and 10,000 in year three. Again, the condition is what? That the entity has to create 10 new jobs, and they have to be maintained for a period of 3 years. So again, the first question, whether this is a grant? Yes, this is a grant because you would be eligible for a grant of 60,000. Again, you have to meet certain conditions, which is creation of jobs as well as maintaining them for the next 3 years. Now, as far as the cost is concerned, which the entity will incur, they will incur a total cost of 30,000, right? For probably selecting the new recruits, and they would also be incurring 1 lakh rupees of wages, which will rise by 10,000 in each subsequent years. So if you would look at the box below, what we are suggesting is not to recognize 60,000 upfront, but to recognize 60,000 in the ratio of incurrence of cost over a period of 3 years. So over a period of 3 years, you will recognize or you will incur a cost of 3,60,000, right? So if I have to explain for year one, you will pay a fixed fee of 30,000 for recruitment and a salary of 1 lakh. So 1,30,000 is the cost of year one. Now that will again go up, right? 1,30,000. Next year it will be 1,10,000, and in the next year it will be 1,20,000. So 30,000 is a one-time cost, and 10,000 is the variable amount of wages which you will be incurring incrementally in year two and year three. So 3,60,000 is what you will incur over a period of 3 years. Over a period of 3 years, you will get a grant of 60,000. So you divide 60,000 by 3,60,000 and prorate that on the year-wise cost that you are incurring. So in year one, you divide 60,000 by 3,60,000 and multiply by the cost incurred in the current year, right? So again, an example where we are trying to articulate that the the intention of the standard, as we have been talking, is to compensate the entity on the cost that you are incurring on a systematic basis. So as and when in this particular scenario, the entity would be incurring cost, be it one-time expenditure on headhunting or salaries and wages, that would be compensated through the government grant over a period of 3 years. Yeah. Now, in certain scenarios, governments might give grant as a package. For example, there is a big scheme which a particular state government has laid out for, uh, let's say, creating employment or creating infrastructure in a very remote part of a state, right? So they are very big scheme in that sense, where there is a portion of an income related grant, where is a portion of an asset related grant. So there will be one master scheme, and you would be eligible for various incentives if you are willing to leverage that particular scheme. So the standard very clearly articulates is that you have to break the incentives based on its type. So it is not that the entire grant has to be, or the entire scheme has to be accounted as a single package. If there are different benefits that is emanating from that particular scheme, you would need to allocate or split the scheme into a grant, into an asset based grant or an income based grant. So one accounting treatment may not fit for all the incentives that an entity is getting, right? So in certain cases, this might even require management to exercise significant area of judgment, right? So they would need to exercise care in identifying the conditions which gives rise to cost and expenses for the period in which the grant will be earned. So in a nutshell, what we're trying to explain is that if there is a grant scheme where you believe that there are two or three incentives that the entity is getting, we would advise to look at each and every incentive carefully, because there might be a scenario where a few of the grant might be asset based grant and some of them are income based grant, right? What about unconditional grant, right? So we have seen certain instances, especially during the pandemic, where the government had given grant without any condition, because they are because their idea is to incentivize or support a particular uh, industry or a particular class of industry, and they want to give immediate support or assistance to the entity. So if they are unconditional government grant, they are supposed to be recognized immediately in the financial statements, uh, because because there is uh, because there might not be any further cost, right? And they are intended to support the entity immediately, right? So we would have seen this in the time of pandemic, where various government had come up with various incentive and support schemes. Okay. Now, let's talk about non-monetary grant. So, if I have to give an example of a non-monetary grant, let's say the government gives you a particular item for free or at a reduced price, right? So, the as I said at the beginning itself, the standard does not prescribe its accounting based on the manner of government grant, be it a cash or be it forgiveness or be it a non-monetary grant. As long as there is a way to incentivize a particular entity, it would qualify under the definition of government grant. So in that case, if there is a non-monetary government grant, then the standard would require the entity to assess the fair value of the non-monetary asset. and then account both the asset and the grant at its fair value, right? So you do, let's say you get a land for free, you find out the fair value of the land, you capitalize the land at fair value, and you also book a liability of or a deferred income of grant uh, uh, in the liability side. The standard also provides an alternative course, which is to record the grant at nominal value. So in this example, the entity might choose to recognize the grant or the asset at nominal value, right? So again, there are two uh, options which the standard envisages. One is to recognize a non-monetary grant at fair value, or to recognize the grant at the nominal price. Let's again understand this by way of an example. For example, PQR received a land from government for nil consideration, right, for setting up a new manufacturing unit. The fair value of the land is, let's say, 10 crores. How should PQR present the land in its financial statements? So, as I said, there are two options. One is to recognize the land and the deferred income on government grant at its fair value, which is 10 crores, or to record both grant and land at a nominal value, for example, at rupee 1. Uh, but whichever option the entity intends to choose, they would be required to make proper disclosure so that that their judgment and the effect on the financial statements is very clearly uh, understood. So again, if I would go back to Ind AS 1, which talks about materiality, significant estimates, and judgment, one of the important criteria that the standard lays out is to have a very clear and transparent disclosure and to avoid obscurity. So again, this particular example would be in that direction, where the entity would be needing to provide additional information to ensure transparency and management's rationale for choosing a particular set of option. Okay. Uh, let's take few more scenarios. For example, loans from government, right? So let's say there is a loan which which an entity has taken from the government, and under the scheme, the government forgives those loans. For example, the micro or small industries, there's a scheme that if any sales tax or any GSTs or any indirect taxes are due to government, the government is willing to forgive, right? So that is also a kind of a government grant. Or the government might be giving funding at nil or low interest rate, right? So again, as I think we discussed in one of the previous example, that that the difference between the market price and the price being charged to the entity by the government, that is the benefit which the government is intending to provide. So the difference between the cash received and the difference between the interest rate is basically the benefit which the entity is getting from the government. But in those scenarios, how should we account for the government grant? So this standard is very clear. They link it back to another standard, which is Ind AS 109. And as far as the Ind AS 109 is concerned, the loan taken by the entity would be recognized at its fair value. And the difference, which is the difference between the cash and the discounted value, is accounted for as Ind AS 20. That is basically the government grant, right? So, in a nutshell, here the entity is not at the first steps paying and then getting a refund, but there is a net mechanism where they are being waived off of of a particular rate of interest, and they're also getting interest at a lower than market value. So again, let's understand by way of an example, right? So for example, Drago operates in an area where the government provides interest-free loan to aid investment. Now, the interest-free loan is received for INR 5 million for investing in new projects. As far as the fair value of the loan is concerned, the fair value of the loan is 4 million. So let's see how the entity will recognize the interest-free loan in the financial statements. So there will be an inflow of cash. So they will debit cash by 5 million. They will create a loan uh, liability of 4 million, and there will be a government grant of 1 million. So the difference between the fair value and the cash consideration under under the Ind AS 20 is considered as a government grant. Okay. Now let's move to some of the finer aspects. For example, presentation of government grant in the balance sheet and presentation of income in the statement of profit and loss. Okay. So again, if the grant is related to an asset, the standard again gives you two options. If the grant is related to income, the standard again gives you two options. So all these options are prescribed in the standard. There is no hierarchy or there is no preference as far as the standard is concerned. So again, an area of judgment which the management would need to set out and based on their assessment, identify what is the most appropriate manner of presentation of grant in the financial statements. So let's see what are the options for an asset related grant. So first option is to present the grant liability as a deferred income in the balance sheet, right? So as and when the costs are incurred, a portion of the deferred income will flow to the P&L, which will then offset the expenditure incurred. The other option is to deduct the grant from the carrying value of the asset. So in a nutshell, what happens is that the entity then recognizes a reduced depreciation charge, right? So from a PBT standpoint, it may happen that both land up to the same number numerically, but certain entities might feel differently, and they might like to first book the entire expense on a gross basis and then recognize a corresponding income uh, in the profit and loss. But again, whatever option they choose, they would have to disclose their rationale in the financial statements. Let's move to income related grant. As I said, again, there are two options. One of them is to present separately or under a general head such as other income, right? So one option is that you show that as a separate item in the statement of profit and loss, or maybe in some other heads, for example, other income. The other option is to deduct them from the expense line item, right? So again, numerically from a PBT standpoint or a PAT standpoint, probably the number will remain the same, but there would be separate line items which might get affected based on the option which the entity wishes to choose. Okay. Now let's understand this again through an example, right? So let's say the entity has received a government grant to compensate for some environmental related expenses. Now, that expenditure is expected to span over the next 5 years, right? They have received a grant of 10 lakhs for compensating for environmental related costs. The cost on environment protection is expected to be around 3 lakhs per year, and it would be spent over a period of 5 years. So again, as I said, two options which the entity might consider. One is to recognize 2 lakhs income per year under the head, either separately in the profit and loss account, or if they so decide, under the head other income. The second option is to also deduct them from the related expenditure. So here I would be recognizing a net 1 lakh rupee of expenditure in the financial statements. So in option 2, I will have a net expenditure of 1 lakh, whereas in option 1, I will have 3 lakhs of expenditure and 2 lakhs of government grant. Net from a PBT standpoint, my number remains constant. So as I said, under the standard, both methods are permitted. They also don't seem to suggest preference of one option over the other, and then it leaves to the management to decide based on their judgment. But in this particular scenario, what I would like to highlight is that it might be appropriate to choose for option 2, right? Because they are specific to a particular expenditure, right? So as a practice, what I have seen, some of the entities making that judgment call that if it is related to a particular expenditure, it would be appropriate to net this off against against that expenditure line item. But again, it is for the management to apply their judgment and take a call. Okay. Now, again, a very important question that is relevant from an Indian standpoint. Though the standard states that it should be recognized as under a generic head, such as other income, Schedule 3 to the Companies Act 2013 has a line item between revenue and between other income, right? That is other operating revenue, right? So let's see whether it is appropriate to recognize a grant under the other operating revenue line item, or there is a specific prohibition of recognizing under that line item. So again, from a technical perspective, um, grants related to income are presented as a part of profit and loss, either separately or under a general head such as other income. So this is exactly what the standard says, that it is either you can present it separately or under a general heading such as other income. So other income is given as an example or a probable direction where they believe that it might be appropriate. So they are not ruling it out that other heads may not be appropriate. They are only giving other income as one of the examples. Now let's see what the Schedule 3 says. Under Schedule 3, it kind of elaborates what does operating revenue mean, other operating revenue. So basically, other operating revenue include revenue from the entity's operating activities, right? Either from its principal or ancillary revenue generating activity. But it is not revenue from sale of products or services. So one of the example which I could recall is which is given in the Schedule 3 guidance note is the sale of manufacturing scrap. So if a scrap is generated in the process of manufacturing, then the sale of those scrap are also covered under under other operating revenue, right? So again, internationally there is no heading called as other operating revenue. It is more of an Indian phenomena which has been prescribed under the Companies Act 2013. Another important criteria for the Schedule 3 perspective is that Schedule 3 prescribes the minimum requirements for disclosures, and they envisage that if the management so desire, they can also include a separate line item or sub-line item on the face of the financial statements when such presentation is quite relevant to the understanding of company's financial performance and financial position. So again, it also gives enough flexibility to provide a separate line item. So holistically, if you would see that there is no explicit requirement that the income from government grant should always be presented in a particular line item. So again, it could be a significant area of judgment by the management, and they should be making appropriate disclosures or appropriate assessment before they want to choose any of the options. So, if I have to answer this question, whether they can be, how should they be recognized in the statement of profit and loss? The grant income might be presented as a separate line item between the revenue from operations and other income. So again, the considering that there is no specific prohibition or a bar, it would be acceptable if the income from government grant is prescribed under other operating revenue, right? But yes, needless to say, there has to be adequate disclosures that should be made as far as the compliance with the guidance note is concerned. Okay. Now let's understand again with an example. So let's say the company is eligible for an incentive under service export from India scheme, right? Uh, under this scheme, the entity will do certain exports, and which based on which they will be eligible for an incentive under the SEIS scheme, right? Now the benefit is recorded in the year in which the services or is provided or the cost is incurred. Now, if we go step by step, the objective of the scheme is to encourage and maximize exports of notified goods. Then the first step or the first criteria is met, that yes, it is a government grant, right? And the incentive to the company can arise from its normal operating activity because the entity is exporting its goods and services, and hence it is a part of its normal operating activity that makes the entity eligible for a government grant. Now, what I could also gather is that these grant would entitle the entity to get some scrips, right? So now the question is that the income from that from the scrip or the grant, should that be recognized under other operating revenue, or can that only be recognized under other income? So as we discussed, considering the requirement of the guidance note and lack of explicit prohibition, the SEIS grant income can be recognized as other operating revenue. The entity should also be giving proper disclosures in the financial statements to explain the nature and to explain the nature of what is going into other operating revenue. Yeah. Okay. Now there are certain special considerations. For example, impairment assessment, right? So let's understand this better with an example, that let's say company R has received a government grant against a particular item of property, plant, and equipment, right? Now, after a few years have passed, because of the triggers for impairment, the entity is supposed to perform an impairment assessment. Now, when I'm performing the impairment assessment, there is also a deferred income which is sitting in the balance sheet on the liability side. So that is the option the entity has chosen. They have not set this off against the value of property, plant, and equipment, but it is being shown separately as deferred income. So in that case, when we talk about impairment assessment, a natural question is whether this deferred income, which is sitting on the liability side, should be set off against the value of property, plant, and equipment, and then they should identify the carrying value of the entity of that CGU or asset, or the recoverable value. So impairment, as we all know, is the amount by which the carrying value exceeds the recoverable value of the CGU or the asset. So if we have to uh, do a sense check, this standard is very clear that even though from a balance sheet presentation standpoint, there is a gross presentation, which means that the plant and machinery are shown separately on the asset side, and the grant income, deferred income is shown separately on the liability side. Regardless of such manner of presentation, as far as impairment assessment is concerned, both has to be netted off, and then the recoverable value or the carrying amount should be assessed, right? So if I have to repeat, irrespective of the manner of presentation in the financial statement, which is basically a gross presentation in this particular fact pattern, impairment assessment has to be done on a net basis. And the standard very clearly articulates this particular point of view. So the deferred income should be set off against the uh, the uh, the carrying value of property, plant, and equipment, and then only the impairment computation should be carried out. Okay. So let's talk about refund of government grant. First, I would expect these kind of scenarios to be extremely rare, right? Where you have got money from the government, but for whatever reason you would be required to refund the money back to the government. So and that could happen either it is a asset related grant or an income related grant. But the moot principle is that irrespective of the nature of the grant, the refund should be accounted for as a change of accounting estimate under Ind AS 8. Okay, so Ind AS 8, as we all know, deals with change of accounting estimate, change of accounting policies, or change of prior period error. As far as accounting estimates are concerned, they are recognized prospectively, whereas a change of accounting policy or a correction of prior period errors are to be recognized retrospectively, unless there is unless it is impracticable to make those retrospective adjustments. So if I have to talk about the first one, which is related to an asset, right? If there is a refund of grant, then the entity would be increasing the carrying amount of assets or reducing the amount of the deferred income balance amount payable. So it will just be a reversal of the original entry to the extent it is appearing in the financial statement. Now, depreciation that would have been recognized in the absence of grant is expensed immediately. Since you're doing a catch up and it is a change of estimate, you would recognize all of them, all of the incremental depreciation expense in one go. Now, as far as the refund of income related grant is concerned, the refund will first be applied towards unapplied uh, deferred credit and then charged to profit and loss account. So net, the liability that is sitting off in the financial statement has to be removed, and whatever are the consequential effects, be it effect in the capital assets or be an effect on the financial statement line item, that has to be reversed, and the effect has to be given prospectively, right? Again, if I have to reiterate, these are in the nature of change of estimates, and they are not a change of accounting policy. Okay. Now, let's move to disclosures, right? Now, as far as disclosures is concerned, uh, the material accounting policy adopted by the entity should be should be uh, explained in the financial statements. As far as Ind AS 1 is concerned, they talk about material accounting policy information. So again, area of judgment where the management would need to identify whether the accounting policy on government grant is material to the financial statements or not. If yes, then they have to frame an accounting uh, policy. Now, over the years, uh, as we have seen the accounting standards developing locally as well as internationally, they expect a customized kind of a disclosure when they talk about accounting policy. A boilerplate disclosure, which is basically a copy paste of the specific requirements of the standards, is not that what the regulators expect from the preparers of financial statements. So for ensuring high quality disclosures and high quality financial statements, it is urged that the preparers of financial statements have a very customized kind of a accounting policy, which helps them to tell their story or tell their point of view of, of the way they are accounting for government grant, right? If you would also look at few of the observations by the FRRB or the QRB, I think that aspect has also been highlighted a couple of times on giving a very customized and not a boilerplate or a standard kind of a accounting policy. Second important disclosure is to have a disclosure about the method of presentation adopted in the financial statements. So I think we talked about one or two items, whether it should be an other income or other operating revenue. What is the rationale which management uses to distinguish between these two options is what the preparer should be disclosing. Again, which of the options the entity is choosing, whether the grant is set off against the carrying value, or they want to recognize a deferred income, or they want to set this off against a particular expenditure, or they want to show it as a part of income. What is the rationale for choosing the option which the management has chosen? Now, the expectation is to explain the particular facts of the case and also to avoid obscurity of information. So sometimes uh, what we have seen is that a very a very broad kind of a para or a very long para is inserted in the financial statements, and the actual intent of that disclosure is somewhere lost. So at this point, I would like to highlight the definition of materiality under Ind AS 1, which say that if an information is obscured, that could also be a material item that should be considered. So again, a transparent way of disclosing management's rationale and why do they believe that this particular option that they've chosen is appropriate based on their judgment is what the expectation of these standard setters and the regulators is. Next, the nature and extent of government grant recognized in the financial statements. So what is the amount of grant that has been recognized, and to what extent are there some other amounts which they should be recognizing in the financial statement? That also uh, should be disclosed in the financial statements. We also spoke of government grants, right? Sorry, we also spoke of government assistance, right? So, and the benefit that the entity is getting because of the government assistance, which are not government grants, that would also require a disclosure. For example, we discussed about that example of quota for a group of micro and small enterprises. They are government assistance, but they are not government grants because you cannot assign a particular value, right? So that is what, again, a disclosure which the entity would need to explain that why is this a government assistance. Uh, if there are unfulfilled conditions or other contingencies attached to the government assistance, for example, there are forward-looking or futuristic conditions, those also need to be explained in the financial statements. Uh, so these are the specific disclosures which are there in Ind AS 20. What I would also like to bring to your attention is the requirement under Ind AS 1, which tells the management or other places an overarching kind of a requirement, right? Which tells the management to explain whether there are estimation uncertainties which the management should be considering disclosing. So even though you have a specific disclosure requirement under Ind AS 20, the standard setter don't think that this is this is kind of a checklist, or these are the most complete kind of a list of disclosure. They should also look at the overarching requirement under Ind AS 1, where they specifically talk about estimation uncertainty. If those conditions or those considerations are triggered, then in addition to what is disclosed under Ind AS 20, the management might need to explain additional uh, matters. Uh, and also, if you would look at from a standard development side, there is a increased focus on disclosures. So be it the new standards on leases or be it on revenue, there's a significant amount of focus on disclosures. So locally as well as internationally, there is a significant ask from the preparer to have a very clear cut, customized and transparent disclosures. Boilerplate, boilerplate disclosures or copy pasting the requirements of the standard should strictly be avoided. Okay. Uh, so we also thought that it would be important to discuss what are the common pitfalls which somebody can encounter. Now, in my experience, these are the key pitfalls which people encounter while assessing the accounting of government grants. First and the foremost, whether a grant exists. So I think those three boxes which I spoke of in the past, transfer of resources, compliance with conditions, and the ordinary recourse of business. I think each and every incentive scheme of the government should be looked at from those three boxes. If they are, if they are ticked, then it is a government grant. So for example, if there is a scheme which will benefit the entity from a lower income tax perspective, where they will get a reduction on income, that is not a government grant. But if there is an exception or exemption to particular entities or particular businesses, for example, the software technology park or any other scheme of the government where you get a benefit from a duty that is under the definition of a government grant. So I have seen instances where people have not or there are confusion whether this is a government grant or not. So again, I would urge you to look at those three considerations: transfer of resources, compliance with conditions, and ordinary course of business activity as your guiding factor for identifying whether a grant exists. Uh, Next, there is also a confusion which standard to apply, right? So if you would answer the first question, then I think the second question is easier to answer. So one of the example I think which I took is whether Ind AS 20 should apply or Ind AS 115 should apply. So again, to avoid those confusion, if we are very clear that those three conditions of Ind AS 20 are met, then it would be very difficult to say that it would fall into other accounting standards, right? So again, identification of government grant and confusion between the type of standards to be applied is one of the common pitfalls that we have seen. Uh, Incorrect treatment of loans, right, below the government, below the market rate. So, or let's say if you're overlooking non-monetary government grants, right? So again, the general or perception or the instant reaction is that there is no benefit, right? But I would urge you to look at the substance of the transaction, which is basically to give a benefit to the entities. So both uh, giving a loan at a below market rate, or giving a land for in our example free of cost, that is akin to a benefit which the government is providing. So instead of providing cash support, they have provided a non-monetary item in kind at a zero consideration, right? So in that case, it is a government grant under the ambit of this standard. Similarly, the below market interest rate borrowings, that is also a differential benefit which the entity is getting, because they are recognizing a lower interest charge as compared to other entities. So that also gives them a benefit from the government. Recognizing grant without reasonable assurance, I think that is also a common pitfall. Generally, there is a confusion whether the reasonable assurance criteria is very similar to probable, which is more likely than not. So if I have to reiterate that that the reasonable assurance criteria envisages a much higher kind of a assurance. It is not as that level of a virtual certainty, but it is also not as low as more likely than not. So it is a very high level of assurance which the standard setters are expecting the management to achieve before they recognize any government grant, right? So again, as we discussed in one of the uh, example, is that if there is a proper documentation trail, if the management has provided their rationale for a particular grant, it might be that it's a new scheme, we have lesser of a experience, but if there is a proper management rationale for recognizing a government grant, it is safe to say that the reasonable assurance criteria is met. Uh, unless the management itself believes that they are not able to meet it, right? So there could be certain scenarios where, because of legal complexity, or the complexity in the scheme, or the ability of the management to fulfill the conditions, that could somehow cloud the judgment, right? So again, a very big area of judgment where the management has to assess whether the reasonable assurance criteria has been met. Yeah. Lack of proper disclosures. I think we spoke in the last slide the importance and the focus of various regulators and standard setters on having a transparent and clear disclosure. Um, uh, the boilerplate and standardized kind of a disclosure are highly discouraged, and in certain jurisdictions they have also been subjected to penal actions. Okay. So now let's talk about the difference between Ind AS and Accounting Standard 12. So to give you a bit of a recap, like we have Government Grant Standard under Ind AS, we have AS 12 under Accounting Standards. Now, this standard is modeled quite similar to Ind AS 20, or rather Ind AS 20 is very well modeled to AS 12. But there are some fundamental differences, right? And I would like to highlight certain of them so that you are able to appreciate the requirements of AS 12 as well in a much more simplistic way. So if you have to talk about at a very, very high level, AS 12 is a much more older version of Ind AS 20. So AS 12 was issued many, many years back. It has not gone through any significant revisions, whereas internationally, the Ind AS 20 which is modeled on the corresponding international standard, they have seen some kind of a development and deliberations, which have led to development significantly, right? So even though principally it might appear both to be similar, but there are certain differences. For example, government assistance, AS12 doesn't deal with government assistance, and hence they don't mandate any disclosure for government assistance. Rather, you will not find a definition of government assistance in AS12, right? However, Ind AS 20 elaborates what is a government assistance and to what extent government assistance can be a part of government grant. Uh, Considering that it is pretty old in that sense, the concepts or the newer experiences, for example, of forgiving of loan or below market borrowings from the government at interest, right? Then uh, then uh, then those are not considered in the old standard AS12, right? Whereas in AS 20 they give a very detailed requirement, or rather they acknowledges that forgiving of loan or a government loan at below market is also in the nature of government grant. Okay. Now let's also talk about one of the key difference, which is basically the manner of recognition of government grant. So as I said, AS12 talks about the two approaches, capital approach and revenue approach. Ind AS 20 don't believe in the capital approach, right? So under Ind AS 20, government grant can never be recognized directly in equity, right? Whereas under AS12, grants in the nature of promoters' contribution can be credited directly to shareholders' fund. So they acknowledge, right, that there is that in certain cases the government grants can be recognized directly into equity. Uh, as far as the revenue grant is concerned, under Ind AS 20 and AS 12, I think principally they talk about the same thing, where they talk about systemic and rational basis for recognition of government grant under AS12. Similarly, the standard in AS 20 also deliberate in a similar line, right? Uh, as far as the government grants of non-monetary government grant is concerned, the under Ind AS, since fair value is deeply rooted in all the Indian accounting standards, non-monetary government grants are recognized uh, at its corresponding fair value, right? Whereas under the old standard AS12, they are to be recognized under the using the nominal value. So if you could see on this slide, they are largely modeled on the same lines, but since the AS12 had not gone not sorry be exposed to certain revisions, the newer experiences don't find place in that standard. But I would say the main difference is the manner of recognition and measurement, which is the capital approach versus income approach. Capital approach is still understood and accepted under the AS12 regime, but under Ind AS, it is still not. It is not acknowledged at all. So from a number perspective, so let's say an entity is transitioning from the previous gap, which is accounting standard, to Ind AS. Uh, there might be certain challenges because of this change, this different requirements. But again, Ind AS 101 also have certain practical expedient or transition options which the entity might choose to accommodate these differences. Again, a non-monetary grant, probably a very quite common phenomena in various jurisdictions. Again, since AS12 doesn't acknowledge fair value generally, they have not been able to accept or prescribe recognition of government grant at fair values. Yeah. So now, as far as the resources are concerned, I thought I'll also take this opportunity to make you aware from an ICAI side what are the resources that are available. So obviously, we have Ind AS 20, which will deal with the basic requirement and highlight the disclosure requirement. But I found the other guidances to be equally relevant. For example, there is an educational material or Ind AS 20. They will give you very clear examples or very detailed guidance through various case studies and make you explain the various nuances of government grant. So for example, whether you want to look at the uh, the uh, the the accounting of government grant income under operating revenue or other income, there is a particular question which will deal with that. Whether it is a government grant or not, there are particular case studies which will tell you that it is a government grant, right? Similarly, there are various ESC opinions that are available. So I particularly liked the Compendium of Opinion, volume 39, where they have a specific query on accounting of government grant, right? Uh, I think that should be considered by the preparers for understanding the view of the committee on this important aspect of government grant. Other than this compendium also, there are a couple of recent EAC opinions, which is hosted on the website of ICI. Uh, uh, there was one very interesting example where there is a mix of government grant, right? For example, whether it's in the nature of loan, a second grant is in the nature of reimbursement of expenses, third is it in the nature of capital contribution, right? So again, we also spoke of different types of grant under a same scheme. So possibly these EAC opinions are also quite relevant. So again, I would urge all of you to look at these resource material, which is very well available on the website of ICAI, and consider them in their decision making. Okay, Kashish, that's all I had to cover. If there are any question, uh, happy to take it.
Thank you, Nilanjan sir, for sharing such insightful session with us. It was quite insightful and linked with practical life examples with simplified and approach. So we have got some questions. So I will be taking
Sure,
up
sure.
one by one. So the first question is, how should an entity account for a grant received in advance when there is an uncertainty in fulfilling the conditions?
So, Kashish, I think I covered this in one of the FAQ, in the
Yeah.
one of the case studies also.
Yes. Yes.
So, and I think you use the word that you have received the government grant, and there's uncertainty whether you will be able to fulfill the future conditions. So, I think
Yes.
the standard is very clear. They have categorically spelled out that the mere receipt of money doesn't mean that you are eligible to recognize the government grant as income. It still be shown in my financial statement as a liability because the conditions of income have still not been met.
Got it. Then there is second question. If a government grant becomes repayable after a few years due to non-compliance, how is the depreciation adjusted retrospectively?
So if it is a non-compliance, Kashish, I would urge the queries to first think, is this an error in the financial statements? Right? If I'm supposed to do something which I didn't do, and hence it triggered a repayment of grant. So I didn't fulfill basically those qualifying conditions, right? But I still went ahead and recognized government grant. So I don't think it is as simple as those example which I said, right? Which is more of a change of estimates, right?
Right.
But if there is a non-compliance of this condition, I would like to argue that this is in the nature of an error and then you deal with through the Ind AS 8 route of correcting the prior period errors.
Okay, got it. Then, sir, there is a third question around the same. A company received a grant for setting up a factory in backward area, but due to some litigation, the construction is delayed. How should the grant be accounted for during the pending period?
So I think one of the important condition of a reasonable assurance is that you will be getting money, right? So if there is a litigation, if there is, let's say, an encroachment, or if there is, let's say, a dispute by a local community, it might hinder your ability to meet the qualifying conditions. Let's say you are supposed to construct a factory within a period of 5 years, and then employ, from the local community, a particular number of employees. If there is agitation, then obviously you are not able to meet those qualifying conditions, right? So I don't think the criteria of reasonable assurance is met in that case, and then you will not be eligible to recognize government grant.
Got it, sir. Then there is next question around the same, like if a government grant is received in installment over the time, how should the entity recognize the government grant in its financial statements?
So I think the cash flow of government grant is nothing to do with the manner of recognizing income, right? So for example, if I have to sell goods, right, and I receive money in installments, that doesn't mean I will not recognize sale on day one. I will still recognize a sale, right? I may be recovering that due over a period of time. So I think the same concept applies. And I think the standard and the slide deck that I had very clearly said is that the cash flow doesn't affect the manner of accounting, right? So if you are meeting those qualifying condition, a reasonable assurance, you should recognize a grant income. You might be receiving or realizing that money over a period of time. That doesn't change the systemic way of recognizing a government grant.
Got it. Then there is next question around the same, like a government provides a refund of excise duty to manufacturer operating in a notified zone. So is this a government grant? And if yes, is it related to asset or income?
I think the first answer is yes, it is a government grant. I think use of excise duty nowadays is quite limited because they are generally limited to petroleum kind of a product. But anyway, principally speaking, if there is an indirect tax, for example, custom duty, which I think I covered in one of my examples, if that is being waived off, that is a government grant, right?
Okay.
Now, whether it is an asset or income, I think that would require a much more finer kind of a reading of the scheme. Various states would have various schemes, and the objective of the scheme might also differ. So it is very difficult to generalize whether a refund or a waiver of excise duty will by default be an asset or an income related grant.
Got it. So the next question is, a startup received a cash subsidy of rupees 50 lakh from a state government to promote innovation with no obligation to repay. So how this should be accounted for?
So one of the examples which I took was about unconditional grant, right?
Yes.
So that would then require the startup to recognize the government grant immediately, right? But I would like the queries to exercise caution and actually look at, is this a government grant or is this a government assistance, right? So that I think a deliberation would be necessary. I understand that you have received a consideration from the government, but before you take that call as immediate recognition, it is important that you reassess that it continues to qualify as a government grant and not a government assistance.
Got it, sir. Then there's something around income tax. So like, what are the provisions of income tax regarding that government grants?
So I think at this forum, I would not like to comment on income tax, but very limited. I think we have the way we have in AS 20, AS 12, we also have ICDS, right, which talks about
Yeah.
recognition of government grant. If my memory serves right, I think they talk about recognition of government grant on cash basis, right? But again, a detailed reading of that ICDS should be done before we take a call on the tax computation.
Got it, sir. Then there is next question is for startup. So a startup has received a grant for research and development, which is spread over a period of 3 years. The company incurs higher R&D than the grant amount. So how is this presented and disclosed?
So, it is not necessary that the grant or the government scheme will compensate you 100%, right? They are supposed to incentivize depending on the wisdom of the government, right? It also depends on what location you are working, how the societal benefit will ultimately trigger. So, irrespective of the fact that you are not being compensated 100%, you would be recognizing grant income in the ratio in which you will be incurring those expenditure. So let's say if you budget on year one, you incur a high level of R&D, right? Because you are still testing the waters, right? In year two, probably you will have some learning curve. You have a lesser kind of a R&D cost comparatively. Year three, probably you have higher learning, and then the cost further goes down. So the standard actually requires the management to judge how the expenses are expected to occur over a period of time, and in that basis you churn out the amount of grant as income.
Got it, sir. So then we have the last question. It's around a government provides 60% wage reimbursement for employees retained during the lockdowns. So should this be presented as a reduction to payroll expenses or should it be your other income?
So I think it's a choice which the entity would need to exercise. The standard, as I said, doesn't give a preference of either of the option. But in my view and in my experience, since this grant is expected to target a specific expense item, in practice, I have seen it to be netted off against the expense line item rather than showing it as income. But again, as I said, there is no bar in showing it that also. The management would need to explain in the notes why they have chosen this option in particular.
Got it, sir.
Yeah.
So I think that's it from my side, sir. So if you would like to have some closing remarks.
No, I think it has been great. The questions were also quite engaging, and I hope whatever 2 hours we all had spent together, it had been meaningful to each one of you.
Yes, a very insightful session it was. Once again, special thanks to all the members for joining this session and showing such a keen interest throughout with the questions that they have brought. And thank you for your active involvement and throughout questions. So I think that's it from our side. Once again, thank you.
Thank you, Kashish. Thank you for your time.
Thank you, sir.
Thank you. Bye.
Bye.